Is it possible to have a whole life insurance policy with a 10/90 split and add a lump sum in the first year? Because if it is possible, it means you would have more cash value up front, more cash value long term, and also a lot more flexibility because you're only committed to the minimum premium and you can add funds into your PUA rider at your discretion with most life insurance companies. So today, we're going to look at policies that demonstrate this. Let's get on into it and have some fun talking about whole life insurance. So the specific question we're going to answer is, can I do this? I'd like to fund $20,000 per year, and of that $20,000 per year, I want my base premium at $2,000. I want my PUA payment at $18,000, and then in the first year, I want to add an extra $100,000. So with this type of setup, what it would involve is I have $20,000 going in plus another $100,000. So the total first year deposit is $120,000, which means I need a death benefit large enough to give me a MEC limit of $120,000. So is this possible? The answer is yes, it is possible. However, it does depend on whether or not the insurance company I am considering allows for large lump sums in the first year. There are several companies that allow this. Here are two examples. One, we have a major mutual company, being Guardian, and then we have a smaller mutual company that is popular in the whole life insurance space for individuals that are interested in cash value, being Lafayette Life. So we'll primarily focus on Guardian, but we will look at an example of Lafayette toward the end of this video. Here's what we'll review. So we'll look at scenarios that have funding of $20,000 per year with a $100,000 lump sum. First, what we'll look at is a 100% base premium policy. What this means is of the $20,000 that goes in every year, all of it goes toward the base premium. We do have an initial PUA payment of $100,000, but then no ongoing PUA payments. Then we'll look at a 50-50 split, which means of that $20,000 per year that's going in, 50% of that, which would be $10,000, is directed toward the base premium. The other $10,000 is directed toward the PUA rider, and we add that lump sum of $100,000 in the first year. And then lastly, we have our 10/90 splits, which will have the same $20,000 per year going in. The base premium will be approximately $2,000. The PUA payment will be $18K with the same lump sum of $100,000. And the question is, which option of the three will be the most efficient? Meaning, which one gives me the most cash value, both short-term and long-term? Just when I compare the cash value on all three examples. Then which one has the fastest growth? And when I say fastest growth, I'm talking about looking at the net returns and also the growth in terms of dollars. So let's briefly look at the illustrations and then we'll look at a comparison on Excel. So what we have first is the example with the 100% base premium. How we can tell that this is it is we've got $120,000 going in the first year. Up here is your base premium. So every year after the first year, you'll just see that $20,000 going in through the 10th year. Quick side note, why it's $20,585 in the second year is because the cost of the term insurance is due in year 2. That's the main reason why, and we're not adding anything toward PUAs to offset that. Now with that said, that's very easy to get rid of. What you would do is just decrease your base premium a little bit so your PUA payment covers it. Like this. So here's the 50-50 design, and what the 50-50 has to do with is here's your base, $10,000, and then here's your PUA payment at $10,000. So 50-50, and then you also have that lump sum PUA payment. So your total out of pocket is $120 in the first year, followed by $20K per year through the 10th year. This is the 50-50 split because of that $20,000, 50% of your $20K payment, $10,000, is directed toward your base premium. Make sense? All right. Now let's look at the last illustration we have, which is the 10/90, which we couldn't quite get to 10%. It's about 12.5% in this example. So So our base premium is $2,500. The lowest we could actually get it would be $2,400. I'll explain where we came up with that number in a moment. But then here's your ongoing PUA payment. We do have a little bit of that going toward a term insurance rider, but this is a policy stripped down with the lowest possible minimum premium, and then we are stuffing the PUA rider on an ongoing basis. And we still have that 100K lump sum in the first year. So there's your 120 in year one, followed by 20K per year through the 10th policy year. Why this is not a clean $2,000 is because this is an example with Guardian. Guardian specific rules allow the following. Wherever we set that base premium in the first year, the most we can illustrate is 50 times that in terms of a big PUA payment. So if you take $120,000, which is your total deposit, and divide it by 50, you'll come up with a base premium of $2,400. I rounded up to $2,500 because it's a cleaner number. If you'd like to see $2,400, let us know and we can definitely send you an illustration. All right, so we've got the same product, if you notice that, across the board. Same net out of pocket, $120 in the first year, followed by $20K per year through the 10th year. We can easily fund longer than that. 10 years just keeps it clean, and we get a total of $300K paid into the policy in this example. Let's take a look at a side-by-side. Here we go. So what we've got is the all base premium example first. Base premium, $20,000. Ongoing PUAs in purple, 0. PUA lump sum, 100K. Base plus the PUA lump sum gives you 120 in the first year. Your first year cash value is just about $98,000. That means you put in 120, you have 98, that's about a $22,000 loss. The CV growth is going to show how much your cash value is growing by on a yearly basis. So to demonstrate this, the second year, you'll notice that your cash value growth is just about $5,000. Why that is because at the end of the first year, you're at 97, you added 20 to that. If you add 20 to $97,000, how much would you have? $117,000. If your cash value was 117, your cash value growth would be 0. However, you have more than 117. You've got 122, almost 123. That means you got your 20 back plus another 5K in this example. That's what the cash value growth is displaying here. So this is the example with the 100% base premium. What is highlighted in yellow represents the break-even point. It's between years 6 and 7 with this large dump in. The death benefit is at $2.5 million because that gives him a MEC limit of guess how much? $120,000, almost exact. So we're solving for the minimum death benefit to be able to pay in up to $120,000. Let's take a look at the 50-50 design. Here we go. So what we've got going on here is the exact same out of pocket, 120 in the first year, followed by 20K per year through the 10th year. Where's the money going? Here's your base premium, 10 grand. Here's your PUA rider, another 10 grand. What we won't see in the spreadsheet, but we do see it in the illustration, is the cost of the term insurance rider. The term insurance rider premium is covered by the PUA payment in this particular example, and all of them actually. In the all base premium example, the cost of the term is covered by the dividends that are being produced. Here we go. Cut the premium in half. What happened to your cash value? Well, instead of breaking even between 6 and 7 years, look at this guy, instead, you're breaking even between 4 and 5 years. So you have more cash value up front. What's the first year loss? $13,000 instead of $22,000. Why is it less? It's the exact same product. The reason why is because that premium is cut in half. The base premium does not show up in cash value in the first year. It puts us behind. It's also what we are committed to. So with the example on the left, the annual bill would be $20,000 per year. With this example, the annual bill would be about $10,000 per year. a little bit more with the cost of the term, but the PUAs can be added at our discretion. Lastly, let's look at our 1090 design. What do we see here? Same out of pocket, 120, followed by 20K per year through the 10th year. First year cash value growth, $6,000 loss. If we crunch this math, our cash value is about 95% of our first year payment. How you can do that math, if you're wondering where we came up with that number, is you can take your first year cash value, which would be $113,968, and divide it by your payment of $120,000. And you'll come up with just about 95%. That's how we came up with that number. All right, cool. So as we look at these guys side by side, what do we notice? Well, up front, by far, we've got the most cash value here because our base premium is $2,500. We're minimizing that premium, which takes the biggest bite out of our cash value up front. Now, if we look at the second year, which one's the most efficient in terms of cash value growth? It'd be the all base premium example, but it only occurs in the second year. Once you hit the third year, then what happens? Well, things normalize. Where we see that 1090 design produce the most cash value in terms of growth. And again, this cash value growth column is showing what you are getting from the insurance company on a yearly basis. Meaning we're backing out your payment and seeing how much did the insurance company give me? That is all I want to know in this particular case. So in terms of cash efficiency, by the 10th year, which one grows the fastest? On the left, you've got your all base premium, $10,561. In the middle, you've got your 50/50, just about $12,000. On the right, you've got your 1090, $14,500 and change. Which one has the most cash value by the 10th year? All base premium was at $330,000, 50/50 split was at $350, and 1090 was at $370. The 1090 has the most money from start to finish during the funding period. What about after the funding period? Well, if we look at the 20th year, there's your cash value. There's your cash value growth. What you'll notice, cash value is growth is stronger than the two examples to the left. And the total cash value is also highest with the 1090. And we can circle every year, but you'll notice that 1090 design with the same company and same product has more from start to finish. If we scroll all the way down until he's 100, you'll see the same thing occur. So the example with the minimum base premium provides a whole lot more efficiency when we look at the cash value growth. It also provides a lot more flexibility because I'm only committed to that minimum premium. So I'm maximizing my overall cash value, which gives me more money for opportunities. And if life happens, I'm only committed to that minimum. Let's wrap up by going over how you can measure the growth in terms of percentages and also dollars. So the product we looked at was Guardian's L95 policy. We had the illustrations up earlier. Here they are with their 5% PUA fee. They also offer their 10% PUA fee, which is as follows. And let's do this just to make things easier. So if you want to see how you can measure the growth here, there's two things you can do. One, we can look at the annual rate of return, which can also be referred to as our annual yield. This will show the net growth rate on a yearly basis because your dividend will not show the net rate. The dividend rate is the gross rate applied to your policy after the cost of insurance and everything. Now, this annual ROR, you can get it from most life insurance companies and actually have it shown on the PDF illustration as well from the insurance company. What you'll notice with these two products, or the two different versions of the same product, the example with a 10% PUA fee, we take a bigger hit up front, takes a year longer to break even, but long term, you do have more potential when we look at the net growth rate on a year-to-year basis. Now, the cash value growth is easier to measure. For the first year, what you can do is hit equals cash value minus annual outlay. That's it. That shows the $6,000 hit. For the next year, what you can do is equals the year 2 cash value minus the year 1 cash value. If we stop there, this is what you'll see some insurance companies show, which I don't really like because it's showing the total cash value growth, but it's accounting for your payment as well, which I don't really think is fair, because if I just want to see the true cash value growth, meaning what I got from the insurance company, I wouldn't want to include my payment in there. If you said, hey, how much did I get in interest last year? And I put $10,000 in, would you include the $10,000 payment you made as part of the interest you received? No, it wouldn't make sense. So what you can do here is, remember we did equals the second year cash value minus the first year, then minus the second year payment. There you go. So we can back out our payment, then you can double click to go all the way down, which is cool. Then you can do the same thing over here. That's how we look at the growth efficiency in terms of percentages and dollars. Let's wrap up by looking at Lafayette, which I said we were going to look at toward the end of the video. So with Lafayette, we were able to get the base premium to as low as $4,000 with the exact same scenario. And to provide some variety, we looked at an illustration that shows funding for 20 years. So here's the first year deposit, $120,000, followed by $20K per year thereafter. Here are your guaranteed cash values, and then here is your non-guaranteed cash value based on the current dividend interest rate. With a base premium that low, about $4,000, with $120,000 going into the policy in the first year, you'll notice that the first year cash value is very similar to what we saw in the Guardian example, and the break-even point is just about year 3. This is actually on a 40-year-old male, whereas the Guardian example we looked at was on a 39-year-old male. So if we make things even, they'll be even closer. But it's close enough. You see what's going on here. Continue to make the payments. Here we go. Through the 20th year, we could go longer if you'd like. There you go. I said I'd show the breakdown of the base premium. Here we go. There's your underlying base premium, $4,000. And we used a 7-year term rider because of the huge lump sum that we started with. So when you look at the MEC rules with a life insurance policy, if I start with a very large lump sum, like $120,000, I need to start with a very large term rider in order to get a MEC limit of $120,000. I don't need to carry that $120,000 MEC limit forever if I never plan on hitting that again. So if someone was continuously putting in $120 per year, we would set it up differently and keep a term rider for a long time. In this case, since the max that they'll ever pay after the first year is $20K per year, well, we'll just cut the term rider after the 7th year, continue with the PUA payments, and we don't have to worry about a MEC situation. There is no MEC in any of these examples. Anyway, I hope you enjoyed this video. If you'd like to see a video where we provide a lot more detail and go through the illustrations in depth, we actually start with a baseline case study of the Guardian example as you saw, but with no lump sums to start. We just look at $20K per year first with the all base, 50-50, 10-90, and then transition into the lump sums and just break everything down. You can check out this video here, and if you have any other questions, feel free to leave them in the comments. And as always, I hope this helps.